Are the markets on the brink of a crash or poised for a rebound?
That's right. We've gathered insights from renowned analysts like Joseph Wang and Adrian who dive deep into the latest economic signals.
In just a few minutes, you'll gain critical insights without the hours of watching.
To kick things off, Joseph Wang will break down the bond market complexities and what it means for investors.
And that's just the beginning. Stay tuned for more expert analyses that could impact your investment strategy.
Remember, these insights are for educational purposes. Always do your own research before investing.
Today, we're reviewing Joseph Wang's latest insights on the market's performance, particularly his focus on the global bond market sell-off and its implications for the broader economy.
Joseph highlights that the turbulence in equity markets is closely related to shifts in bond yields and expectations regarding Federal Reserve policy.
Joseph Wang argues that the recent rise in bond yields is largely due to shifting market expectations regarding Federal Reserve rate cuts.
He points out that as economic indicators strengthen, the market anticipates the Fed will be more cautious with rate reductions. Wang explains that the bond market has recently seen a major sell-off, particularly in U.S. Treasuries, contributing to rising yields globally.
This trend poses challenges for other economies, which are pressured by higher U.S. yields. Joseph also notes that the U.S. labor market remains robust, with job creation exceeding expectations.
The drop in unemployment rates signals a healthy job market, which influences the Fed's policy decisions regarding interest rates. Wang emphasizes that investor sentiment often diverges from textbook economics, impacting market responses in unexpected ways.
What does Joseph predict for bond yields moving forward?
He forecasts that as long as the Fed maintains a steady policy, bond yields should stabilize above 4%.
Joseph Wang concludes that investors ought to closely monitor Fed policy changes, as these will heavily influence market dynamics.
He advises considering portfolio adjustments based on economic signals and bond market performance.
Today, we're analyzing the December labor market data with insights from Steve Van Meter.
Steve highlights the surprising payroll figure of 256,000, significantly above expectations, prompting discussions about the state of the labor market.
Steve indicates the payroll figure is unusually high, but questions whether it signifies a real improvement in labor conditions.
He emphasizes that despite this uptick, many sectors are not engaging in substantial hiring, suggesting seasonal effects rather than real growth.
Steve expresses doubt regarding the December payroll figures, noting they likely stem from seasonal hiring rather than strong demand.
He observes that many of the new jobs are part-time or temporary, complicating the outlook for the labor market.
Steve mentions the contraction in the manufacturing sector, questioning its alignment with the reported payroll growth.
The household survey shows a minor rebound without alleviating concerns about the overall health of the labor market.
Steve predicts that absent meaningful policy changes, the labor market will struggle to recover.
He stresses that discrepancies among various data sets could mislead analysts.
Steve warns that without an increase in participation rates alongside payroll growth, the labor market's overall health may be questionable.
He asserts that unless robust economic growth coincides with these payroll figures, the economy remains vulnerable.
In conclusion, Steve emphasizes that the elevated payroll numbers warrant skepticism.
A complete understanding of the labor market requires careful examination of intersecting data trends.
Today, we're reviewing insights from Adrian about the latest job market data and its implications for the economy.
Adrian highlights the strong jobs report but raises concerns about low labor participation and other underlying issues.
Adrian interprets the latest job figures, noting they suggest a stronger economy, but cautioning about low labor participation.
He emphasizes the importance of the focus on how the metrics play out in the coming months. Adrian emphasizes that public trust in job numbers is waning due to frequent downward revisions.
He mentions continuing claims are at a 3-year high, underscoring job market difficulties.
Adrian notes the rise in inflation expectations, highlighting consumer sentiment's impact on market dynamics.
Despite inflation worries, robust consumer spending complicates the Federal Reserve's projections.
What are the implications of strong job numbers for gold investments?
Adrian points to rising gold prices as indicative of strong demand despite mixed economic signals.
What predictions does Adrian have for the economic landscape over the next year?
He suggests inflation pressures may continue due to the complex interplay of market forces.
Adrian concludes that remaining aware of labor market shifts is vital for investors.
He stresses that understanding inflation dynamics is key for strategic investment decisions.
Welcome to Real Estate Mindset. Today, we're diving into an insightful analysis by a real estate expert on the current state of the housing market.
This expert emphasizes the importance of understanding raw data in navigating real estate, especially in a turbulent market.
The expert outlines a 6-step process for accurately pricing properties, beginning with solid data from the MLS.
They stress that using sold data helps create a reliable market analysis to determine fair prices.
Despite reports of heightened buyer activity, the expert notes that overall home sales are declining.
They highlight that rising mortgage rates are significantly affecting affordability.
The expert critiques the use of proprietary data by companies like Redfin, arguing it can create an illusion of market stability.
Instead, they advocate focusing on raw data to better understand market fundamentals.
Looking ahead, the expert forecasts that mortgage rates are likely to maintain high levels throughout the year.
They also predict that ongoing affordability concerns will keep many prospective buyers sidelined.
The expert underscores the importance of monitoring economic indicators, especially job market trends, in shaping housing demand.
They believe a thorough analysis of data will provide clearer insights into future market shifts.
In conclusion, the expert advises potential buyers to remain data-driven and financially prepared for upcoming challenges.
They remind viewers that avoiding emotional decisions is crucial in this volatile market.
Today, we dive into an analysis by Matt from Trade Brigade, focusing on the recent labor report and its implications for market corrections.
Matt highlights how the stronger-than-expected labor report has pressured equities lower.
Matt believes a larger market correction is likely, given the recent sell-off and underlying market indicators.
He suggests historical trends show markets experience approximately a 10% correction annually, indicating we might be on track for that.
What does Matt identify as key indicators for a correction?
Matt identifies the labor report's influence on interest rates and a weak closing price relative to support levels.
How do various sectors impact the overall market outlook, according to Matt?
Matt notes that energy and healthcare are leading sectors, while tech and real estate demonstrate notable weakness, indicating a more risk-off environment.
What does Matt predict for the market's immediate future?
Matt predicts a pullback of around 7–10%, with crucial support levels around 565 to watch.
What actionable insights does Matt offer for investors navigating this market correction?
Matt advises investors to closely monitor key levels and consider sector positions for strategic investments as the market adjusts.
Today, we're exploring a complex outlook on stocks as Lance Roberts expresses a tactical bearish view based on market indicators.
Lance highlights significant concerns regarding slowing economic growth and elevated stock valuations.
Roberts believes that economic indicators point to worrisome trends for the stock market.
He stresses that unsustainable high valuations lack solid backing from economic growth.
Roberts notes that current market valuations present risks if not supported by earnings.
He warns that without significant economic growth, these high valuations could lead to a market correction.
Rising Treasury yields could restrict borrowing and trigger market corrections.
Roberts cautions investors to stay vigilant as the market adjusts to ongoing rate adjustments.
Roberts discusses the driving role of consumer sentiment in economic activity.
Understanding shifts in sentiment is essential for predicting market movements.
Roberts anticipates a market correction arising from current economic difficulties.
He advises caution in navigating the increased volatility expected in the year ahead.
Roberts concludes that monitoring real economic indicators is vital for future investment success.
Investors should systematically assess their portfolios against evolving market conditions.
What a whirlwind discussion we've just had. Our experts really brought their A game today.
Absolutely, from Lance Roberts to Joseph Wang, each guest dissected complex economic indicators and forecasts.
What really stood out to me was their alignment on the significance of labor market metrics, yet they diverged quite a bit on interpretation.
Right? Lance had this bearish view on stocks due to high valuations, while other guests like Adrian talked about potential investments in gold amid inflation.
And did you catch how Steve highlighted the difference between strong job numbers and the real economic picture? That was eye-opening.
Exactly. It's almost like a cliffhanger. The headline statistics could be telling a very different story than what's really happening.
For all our viewers, if you found this dialogue enlightening, make sure to hit that like button and subscribe.
Your support enables us to continue delivering in-depth insights from top financial experts.
And don't forget to tune in next time, where we'll unravel the complexities of global bond markets. You won't want to miss that.